All right, welcome back, everybody. Today is Wednesday, April 4th, 2018. This is the 7th episode of Rebel Trading Group podcast.
Is it the 7th or is it the 8th?
I think it's the 7th or the 6th. I can't remember.
We're cooking. I definitely know it's not the 6th. It's either 7 or 8.
Okay, so it's definitely the 7th.
I'm almost positive it's 7.
Welcome to episode 7.
Or 8.
And my name, of course, is Nathan Oliphant, and with me, as always, is the gluten-free Jason Bessing.
The gluten-free Jason Bessing. What is up, everybody?
Today was a great day for me.
You had a good day. Why don't let's wait for that. Let's wait for that.
Of course, yeah.
I'm going to hit us with the numbers. I'm going to start with the S&P gaining a nice 30 points. NASDAQ gaining about 100 points.
It's about fucking time.
The Dow, funny story here, gaining 231 points, but moving 760 points for the day.
Wow.
We opened low. We opened around 500 points lower, and then if you look at any charts for the indexes, it's a fucking staircase. All day, ever since the massive sell-off this morning about the trade tariffs, which Mr. Nathan is going to get into, break down for us.
Break it down.
But yeah, the Dow, opened. I was like, oh god, here comes the recession. And then, by noon, by lunchtime, everything was back to normal. So, yeah, fun day with the Dow. All the indexes overall just staircase. Bitcoin still continuing to just not really do much, just kind of sitting there.
It's down,
sitting at 6,860.
That's down.
So
that's not
she's
good.
Still down. I'm gonna go ahead and pull this one out real quick, just because I like to talk about some market movers. This one caught my attention, and I kind of want to get your thoughts on it. Under Armor was up both yesterday and today pretty massively. Today it added another 6% up, putting it at over 9% up for the week. That's over 20% over the past 3 months, but she's still down 8% for the year.
I can't believe Under Armour's still around. I can't believe people still buy Under Armour. I mean, I guess there's no really other option for like cold weather gear and stuff.
Well, Nike does the same thing, but the problem is there's so many competitors, and Under Armour's just so expensive. Like,
it is really expensive.
And it used to be a thing, like you wanted to get like the Under Armour gear for when you were playing ball. Like I remember being like that and doing that. And then like it kind of faded off. And then all these competitors came and made the exact same stuff for like fractions of the price. And Under Armour, in my opinion, is starting to become a little obscure. Nike still continues to dominate them by a landslide. And I just see it as a potentially dying business. I just don't see what they have going for them. Like, I cannot get excited about Under Armour, but had you bought it 3 months ago, you just got a fifth of your money added to your portfolio. So, like, it's hard for me to get behind shit like that. But there it goes. Who'd have thought? It's stocks like that, the ones that you wouldn't think that,
Yeah, technically speaking, if you're looking at the technicals of it, it looks like a pretty nice time to buy it. But there's an analogy I like. It's one of my favorite analogies. It's you don't want to catch a falling knife, which that means is for like a stock, it might be a good price to buy it in because it's really cheap and it's coming off a high or something like that. But who's to say it's not going to keep going down? And that's the idea. You don't want to catch the falling knife, or it's going to cut your hands the whole way down.
You want to wait for the dust to settle. But I mean, when she pops up, she goes the other way. You don't want to do the reverse. You don't want to catch a knife flying upwards
and then let it drop again.
That was a bad analogy. But okay, when the stock goes up, you don't want to chase the performance.
Yeah. Okay.
You don't want to go behind it. And a lot of people might look at a chart just like this and see those numbers that I just gave, the up 20% for 3 months, but still down 8% for a year. They might jump in thinking that there's still a lot of opportunity there. And in my personal opinion, when you see stuff like this, you're too late. You're done. You're gone. 9% for the week, you're done. Buying now, you're fucked. You missed it. Missed it. The biggest move that you would have wanted and would have looked for, especially if you're an options player, it already happened.
Yeah,
it's done.
Don't let hindsight investing control your moves.
Oh my God, hindsight investing is the easiest sort of investing. Oh, if I bought here and sold here, oh my God, I would have done so good, Nathan. Look at that, it's so easy. Nobody's Peasley. I like to quote him, man. He always says, "There's nobody at the bottom ringing a bell. All right, this is it. Start buying. Ding, ding, ding." You can't guess that shit.
Shout out to Invest Talk. Check them out on iTunes.
Okay. We'll plug them in the show notes if you guys are wanting some additional content. But yeah, that's Under Armour. I just wanted to kind of bring that up because the markets were just funky today.
Yeah. All right. So let's get into what am I going to talk about?
You're bringing us into some market news today.
Oh yeah, we're doing a new segment, Market News with Nate.
Yeah, Market News with Nate. You're going to lead the charge on this one.
Yeah. So
what happened today, Nate? What was the biggest headline of today?
So as we may know, the biggest economic power in the world right now is China. China.
With a Y.
Yeah. China's got tons of power right now. They're one of the number one. I think they are the number one exporter to North Korea, and North Korea is a real big hotspot right now, as we may know.
Of course.
So
always is.
To try and deter North Korea from their nuclear advancements, we put on what do you call those things the UN gives them, sanctions and stuff like that. Or we kind of attack their trading partners like China, and we put. I feel like President Trump is going with the America First thing with the steel tariffs and all these tariffs coming in hot, but I really think it's another stab at North Korea. Anyways, as we may know, there were steel tariffs about a month ago.
Steel and aluminum.
I think maybe copper was in there as well.
It was being discussed, I remember. I don't remember specifically, but I know for a fact it was definitely the steel. That was the big mover.
Mm-hmm. And I can't really remember or say that it was directly towards China, but it does have a huge impact on us. It makes our goods less attractive to outside buyers.
If I can kind of add on that.
Sure.
Apparently one of the reasons that... Now, we're not just going willy-nilly attacking China.
No.
They've been doing just some illegitimate business practices and trade practices that have put us on the bad end of it. For example, they'll overproduce their steel. That way they can flood our markets with it. And if you're a business owner and you're buying steel for, I don't know the numbers, $10 a pound here, that's probably not even close. But China is selling it for $3 a pound. Well, clearly, as a business owner, it's just completely wise for you to go with the Chinese steel. So they're dumping it into our markets, and it's crushing our personal economy, and we're importing and we're not exporting. So in order to counteract that, Trump wanted to not necessarily ban Chinese steel, but kind of even the playing field for the American working man, the American steel worker and the aluminum worker. So it's not just a willy-nilly. Am I right? Is that in the ballpark there?
Yeah, I mean,
we're not just willy-nilly saying, "Oh, fuck China."
That's generally how economics will work. You get a better substitute, and then exactly what you said.
Supply and demand. Yeah. I can give you if you're getting chocolate from me for $1, but you can get the same exact chocolate from him for 90 cents. Why are you going to go to me?
10% discount, baby.
Other than the fact that we might be friends, why? So, anyways. So what happened today with China? Because that was about 3 weeks ago now.
Yeah.
3 or 4 weeks ago that those tariffs and sanctions got hit. So what's going on now?
So, let's see. The Trump administration took a direct hit at China. Hold on, I'm fucking reading an article. For its trade practices, detailing more than 1,300 imported goods from the country that would face a 25% tariff. Says about 50 billion worth of imported Chinese goods will be subject to tariffs. This morning I woke up to that number and I was like, it blew my mind. Hold on, let me find the article. Sorry, I usually have it up. Yep, China announces additional tariffs of $50 billion of U.S. goods. There's a tweet out there right now that Trump says this isn't a trade war, but it's exactly what it is. Let's not beat around the bush. It's a fucking trade war.
If he just wanted to fix the steel industry, he would have just left it. Okay, here's this tariff, boom, done, leave it alone. But now that China's hitting back and he's going to want to wave his dick back, it's just going to be a battle of business.
Yeah, and so this New York Times article is saying that the Chinese tariffs target 106 different types of American goods that take aim at the farm belt, including manufacturing hubs. Those are one of Trump's biggest supporters is the agriculture kind of sphere. Now, what that means for the market, I don't think it's very good for the market. Some people say trade war's really good for the market, but I can't see it being good for our two markets, the Chinese market and the U.S. market. When you put mud into the pipes, it makes it harder for water to flow through.
Exactly. Well, the markets have been extremely volatile because of these tariffs. That's obviously a given. That's at least the story we're all sticking with.
I mean, we can look at it because each time one of those tariffs come on, the market seems to do bad.
Oh, it'll move. It'll move.
It'll go down. If you can ask me.
It'll first hit the sector that is directly with it, and then it'll just ripple effect. And one thing that I want to keep in mind, something I'm always keeping in my mind over someone who's trying to grow their portfolio over the next several decades, you got to ignore this stuff and see it as potential opportunity, because all of this volatility is 100% news driven. Our economy, if you're checking these reports that come out daily and weekly, our economy seems to be very strong and growing. In fact, the Federal Reserve would not be raising rates at this rate if they did not think that the economy was growing.
Well, here's the thing about this. If you look at what drives a strong economy, you have to look at why does the Fed raise interest rates? It's because of inflation. Mm-hmm. Right? They don't want too much inflation, or else our goods become overvalued, and nobody can buy anything because the fucking money's just everywhere, and then everything becomes like $1,000 for a cheeseburger. Mm-hmm. One of the metrics that the Fed looks at is housing rates. Are people steadily buying houses? Is the housing market steadily going up? If it is, then there's not really a sign or that is a sign to increase rates, I believe. Mm-hmm. I think I got it backwards. The economy's
growing. People are spending money. They're increasing their standard of living.
Yeah.
When that kind of stuff happens, our economy is great, or at least it appears great until the bubble pops. Whatever bubble was building pops. That's a different story, though. But the point I just wanted to make was that these businesses and these earnings are all still very strong. These stock prices are being hit because of news, not because of bad earnings and a slowing economy and just getting wrecked on the U.S. dollar and places defaulting on loans and just all this craziness that would never happen. That's not what's going on, because these stock prices are dipping into some demand levels that seem to be pretty attractive. Mm-hmm. And the worst part is I don't know when this volatility is going to end. It might be here to stay. In fact, I hope it's here to stay. But you got to keep in mind that if we go and revisit these highs after all this news has settled and you didn't take advantage, you are missing out on over like 10% gains on just about anything.
Is that how much the Dow has dropped? 10%?
Just about. It was at like the 268 mark, something like that, 267 mark, and we just got out. We opened at 235 this morning. So yeah, nice dip, nice solid dip. So the news. Be careful of the news-driven paranoia and excitement.
Yep, you got to park your emotions to the side while investing.
Mm.
So as I was saying, one strategy that people will do is they'll average down or average cost buy-in. Is that right?
Average down, cost down.
And what that means is basically, I hate when people do this. Whenever they ask me for investment advice, first I tell them I'm not a financial advisor, so you might lose your money. That's the first thing. I cover my ass with that, and then I say, if you're really thinking about investing, maybe think about however much you're thinking about, and maybe like take it into quarters or something like that, and then put it in. You feather it in. So if it goes down, you put more money in. If it goes up, you put more money in. But your average cost, is that what it's called? Average cost.
Cost averaging.
Cost
Dollar,
averaging.
dollar cost averaging.
Cost averaging. There we go. Pinpointed right on the head.
There's a lot of advantages with dollar cost averaging. It doesn't give you that fear of moving 3% of your portfolio at once.
Exactly.
3 to 5 to however big you want to go. So sometimes I like to go almost 10%. So it takes away the fear of going all in right then and there. It gives you the chance to kind of enter. Okay, well, instead of going 100 shares right now, I'm going to do 10 here. I'll see how it goes by noon. I'll do 10 here. If I don't like where it's at, I'll wait till tomorrow. And it gives you the opportunity to enter as you like. Now, if you enter it and it just runs up on you, well, that's what I call a lucky problem. But that's just that's a reality of it that you have to deal with. But another advantage that happens is if you buy it and something is at $20 and you bought in, and it now dips down to $15, and the numbers still check out, and you still want it, you can dollar cost average and buy more for cheaper. And you didn't put all your money in at that higher price, and you kept some cash in order to buy more at a lower price.
This strategy especially works with index fund. I'm a huge fan of index fund. If you're just getting into investing, I would definitely suggest getting an index fund, especially if you're younger. A lot of 401ks use index funds, and they really just track the market. If you're younger like us, or 25 and 40 years, if you're willing to make a 40-year bet, an index fund is definitely for you. And I feel and dollar cost averaging is great over like a long period of time, because you can catch all those lows as well during periods of volatility.
Mm-hmm. It gives you the chance to buy in at extremely low prices, and even when the market was going up left and right, and things would dip like 2 or 3% for the day. That was some opportunity to purchase a little bit more right there and add just a little bit more on those dips, rather than just buying willy-nilly. Buying willy-nilly. Well, that was a nice little segue into dollar cost averaging. But today, we have a fun episode, Nathan.
Is it?
It's a fun episode. We're going to talk about playing the downside.
Yay! Short the market, baby.
Shorting the market. So I'm going to precurse it. This is going to be a little bit of a longer episode than normal. One reason that the gluten-free Jason Besson will be out of town, and I unfortunately will not be able to put anything out on Friday.
I might be putting out an episode. I'm not too sure yet. If I find the time, then I'll do it.
I'm hoping you can at least do a solo thing for maybe like 5-6 minutes, just something easy. I think we would all enjoy that. Especially on Friday, give us that final update of the week, and that tagline we need to hear.
Yeah, baby.
But this episode will be fun. We're going to talk about some topics that'll get a little bit more advanced if you're not too much into stock trading. But if you're already an established trader, or know about trading, this might open your eyes a little bit more. So hopefully we don't lose you. We will talk about some things that are complicated. Mostly it's all just jargon. It's all just jargon.
Yeah, that's my thing about the market is that I feel like the big wigs create these terms to keep the simpleton man out of the stock market.
Our equities have increased in value 3% quarterly over the
Liquidate your stocks.
Liquidate the holdings. Blah 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 blah. Yeah. They make all these crazy terms up so that it just appears scary, and it's really not. So this playing the downside, how to make money when stocks go down. This is where it gets fun. This is where it gets scary, and this is where it kind of turns into a casino. So let's play the fucking game, Nathan.
Whee.
So there are several ways to play the downside. First of all, it's a term called shorting. Short, like short stop, or short, like you're a short person, strawberry shortcake. Shorting, betting against a stock, or it's playing the downside on a stock or another security is the best way to put it. If you think something is at $40 and you think it's going to go down to 30 and you want to profit off that, you would short the stock. So anytime you're shorting, you're betting against. I think I've kind of beat that horse right there. So other than that, other than just short selling, there are several ways to play the downside.
Well,
but we're going to start.
Tell me
We're
if you were
going
going to do. Yeah, I was just about to ask that. Tell me short selling. Tell me if I was going to short sell today. How would I go about it?
I'll go through the several ways to play the downside, and when we get to my favorite, I'll tell you a little bit. But short selling is a very interesting concept, because you are playing the downside. So what you want to do when you're short selling, what's actually happening is you're borrowing shares. Don't ask how, just it is. This is the way it works. Your broker handles it. It's all done via computer, complicated algorithms through your broker. Just realize it's something that happens. Just beat it in your head. It happens. You borrow stock, and then you instantly sell it in the open market. And to give easy numbers, let's say this stock is Rebel Trading Group stock.
RTG.
And you want to short it. Hell, I would. You want to short sell. You say, this thing is going down. It's a piece of shit. It's not going to make any more money. I want to make as much money off of it as I can until they declare bankruptcy. So what you're going to do is you're going to borrow, by putting in a short sell order, you're going to borrow 100 shares of Rebel Trading Group, and you're instantly going to sell them in the market for $10. Okay? Your responsibility is to return those 100 shares. Remember, you borrowed them. You must return them. If I borrow your screwdriver, Nathan, I got to return it to you, right?
I'm going to need that screwdriver back.
I don't just have a screwdriver.
Yeah, it's my screwdriver.
Okay? Exactly. It's your screwdriver. So your goal is to now purchase those shares back at a cheaper price than you sold them for, because you have to buy them back. So when you sold something, you got to buy it back because you got to return it to whoever you borrowed it from. So let's say the Rebel Trading Group, you were correct, goes down to $5 a share.
Oh, God.
Yeah, we went from $10 to $5, man. We just sucked. China hit us with a tariff, actually.
50% losses.
Yeah, China hit us with a tariff, and we just sold off that day. So you are happy with your earnings, and you say, I want to run home and take all my money and run off and blah, 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 blah. Touch myself with all my money. So what you're going to do is you're going to do what's called a buy to cover. And all that simply means is that you are buying back the stock that you shorted. So you will now purchase back 100 shares of Rebel Trading Group at $5 a share. And now that is a $500 order compared to the $1,000 that you sold it for. So you now pocket that $500 difference. That, my friend, is a short sell.
Okay, what I don't understand is, like, because you have to buy the shares back, right?
Yes.
So you don't have the cash, you just have the shares.
Correct. Well, that's not true. So if you wanted to, so let's say you're shorting right now, and you go sell out in the open market 1,000.
Yeah.
Or you get the $1,000, right?
Yeah.
You sold the 100 shares at $10. You have that $1,000. That's your money.
Yeah.
But they just have it on your account. They use your account as collateral through what's called margin. When you have a margin account, it opens you to the availability of stock trading. People can borrow your shares. You can borrow other people's shares. And when you have that margin account, you put up your value in your portfolio, that equity that you have, you use it as collateral so that you can do things like short selling or borrow money on credit to buy more stock. You can do all these crazy things with margin accounts. Some margin accounts, if you're a pattern day trader, will let you borrow up to 4 times your equity.
4x gets into the 100 times.
Oh, yeah. 4x trading, if you do currency exchange, oh, my shit. 100-to-1 leverage. You put in $1,000. I'd go for a $10,000 deposit and have that million to trade with.
I've seen Bitcoin traders use like 300 to 400 margin.
That is insanity, bro. That is insanity. So short selling, basically just a quick review. I know we went over it kind of slow, but to kind of quickly go over it, is you sell something in the open market by borrowing the shares. You sell them, and your goal is to return those at a lower price. Now, if the company goes bankrupt, you never have to return those shares. Now, here's a negative to the short side. Your risk is unlimited. If you buy a stock at $10 and you hold that stock, your biggest risk is losing $10. But if you short a stock at $10, your maximum gain is another $10, but your downside is unlimited, because if that $10 stock goes to $100 tomorrow, you now have to pay back $90 for every share that you borrow.
And it could theoretically just keep going up.
Yeah, it could go to the moon. It probably would not, but I guarantee you there's people that have shorted a company because it was $3 a share, and next thing you know, it was that one company that turned itself around and popped into the $25 a share, and people got their asses wiped because of it. Now, granted, you'll get margin called from your broker before then, but they'll still let you take a beating before they say, hey, you need to deposit some money or we're selling everything.
I just imagine
you owe the bank the monies. You pay up, baby.
I just imagine like a shitty broker just letting it cook for like fucking years.
I think there's like ethics laws against that and shit, and plus like they also have their own risk department, because when they're lending out money like that, they got to make sure that they're getting paid too, because margin's expensive. Margin is not cheap to use.
It's debt. It's technically who's ever giving it out is debt.
It's like having a credit card on your portfolio to buy more stock or short more stock. It's scary shit. Oh my God, is it fucking beautiful, Nathan?
I like it. I don't think you should be scared of it.
You shouldn't be scared of it. You should know how to use it. It's not for everybody. If you're a long-term buy and hold, and I want to buy everything I can for the next 10 years and just buy, then margin is not your thing. But if you're trying to get into the trading, even swing trading, where you're going to hold for a couple weeks or so, margin, you want to know how to use it. It's something that you can use as a very powerful tool. Yeah. But it can fuck you hard. It can wipe your clock really quick. Really quick. So, short selling, you borrow shares, you sell them now, you return them later at a lower price. That's all it is. That's all. It's really simple.
When you borrow the shares, you have to upfront the capital first, right?
Yeah, you have to have the money to back it.
Yeah.
At least most of it, because you can go on margin.
Yeah. They don't just give you the shares.
Yeah, they don't just give you the shares. If you have a $5,000 account, they'll let you short sell up to $2,500 of any stock.
Okay.
So you are cut off by the equity in your portfolio. But if you're a pattern day trader, you get 4x leverage.
4x. God, that's so nice.
I'm going to go with number 3 because that's easier than number 2. So short selling, that's a little bit more of a complex, more intricate trader's route to go. The easiest route to go, in my personal opinion, would be the use of inverse ETFs and inverse leveraged ETFs.
Oh, let me talk about this, baby.
I want you to hit them first.
Oh, this is how I first started hedging my portfolios with.
Oh my God! What the fuck is a hedge?
Okay, so if you think about your bushes outside, you don't want them to grow too much, so you hedge them down. I think that's where the term comes from. But the idea is you have long positions and then you have kind of short positions to kind of minimize the losses of the long position. So for me, this is what I do: is I have a 3 times leveraged Dow Jones ETF, and I also have a 3 times inverse leveraged Dow Jones ETF. The thing about it is you want to have, for me to hedge, I feel like if you're in a longer position, your hedge your short position needs to be smaller than your long position. So the short,
significantly shorter.
Yeah,
because you want to balance it out. If you're going for that growth, You want just a little hedge. You don't want to take a huge hedge.
Yeah, and a hedge is basically, in layman's terms, it's reducing your losses on bad days. And with triple leverage ETFs, your losses can be out of the roof. And those inverse ETFs, if you layer those with your normal 3 times ETFs, it doesn't hurt as bad.
So what you're basically saying, if I can make it a little simpler, is that you have potential to catch both the up and the down.
Right.
So first of all, what is an inverse ETF?
The inverse ETFs, they hold swaps. I think what they're called is swaps. At least the ones in SDOW, SDOW, hold S&P 500 swaps. I don't know. For the life of me, I don't really know what that is. I know what like credit swaps are, and like
that's what they are.
Okay. That's what I can't really explain it, but it's basically like a short on the market. If the market does bad, it pays off.
But why? Okay, but why do you want an inverse ETF? What is an inverse? Okay, they hold that, but what does it do?
It goes up when the market goes down.
Exactly. It acts the complete exact 150% opposite, the exact opposite.
Yeah, my favorite
whatever it's trying to do. So if it's SDOW does 3 times the opposite of the Dow Jones, but UDOW does 3 times the Dow Jones.
The S&P 500 one is UPRO, UPRO, and the 3 times inverse is SPXU. Those are spider funds, I believe, right?
Well, the leverage ones are like Direxion.
Oh, and power shares.
And power shares, yeah. So by having both in okay, let's take the leverage part out of it here. Okay. And just say you're a normal person. So you own the S&P in your portfolio, and you hear from the news, you're a waiter at Longhorn, and you hear at the bar that Jim Cramer's saying that tariffs are going to hit. So you're like, oh, well, you know what? I got a lot of money in the market. I should pull it all out and sell everything. Or,
dear God,
you put on a small hedging position by buying an inverse ETF. SH is the opposite of the S&P fund. That's the inverse S&P fund. You have SPY, which is the normal ETF for the S&P 500, and then you have the inverse, which is SH. So what you could do is you could put on a small hedging position if you're expecting the market to go down. And what will happen, yes, your portfolio will go down, but that hedging position is going to make you some pretty decent money because you're betting on the downside. You're betting big on the upside, but you're betting small on the downside.
Yeah, if you were going to put it into like numbers terms, let's say you had a $10 long position and you wanted to hedge it with a short position of the exact same asset. If you had a $10 asset, you maybe want to put a short of about $1. And so that short position, when it goes down or when it goes up against the long position, it decreases. So maybe it like brings it down. Let's say your long goes down $2, so now you're at $8, but your short goes up $1. Well, now you're only down $1 instead of $2.
Mm-hmm. So while the other one's going down, the other one's going up. Mm-hmm. And the idea is that when the dust settles, you eventually get rid of your hedging position. You take those profits off the table and you put it back into the thing that just got crushed, and then you buy that dip. So if you're a long-term S&P 500 indexer and you put on a little SH and you make $100 off of it, and you think, okay, I made money off of the hedge. I think everything's good. I'm ready to start buying again. You sell that and you put that money back into your S&P because that is now cheaper to buy, and you use that hedging position to make a little extra money. So you protect it against the downside. So during all that volatility, rather than just watch your portfolio got wrecked, you made a little bit of money just by getting a little insurance on your portfolio. And that's the best part about it, because it's insurance. If you lose that little bit, it's okay. If you lose on your hedge position, that's because everything else is going up, and you should be making way more money anyway. So much money, it doesn't even matter. That's the goal when you're hedging. Is that about right?
Yeah, leveraged ETFs are my favorite My favorite stock market tool in the market.
Mm-hmm. I shorted the NASDAQ relatively a few days ago. Actually, I bought I bought about 25 SQQQ. That's the inverse. That's a triple inverse NASDAQ fund because she got hammered. And the reason that I bought it is because I bought some call options on the NASDAQ. And Nathan, I called you, I texted you, I was getting absolutely wrecked on them.
Yeah,
we're not going to say any numbers, but I got wrecked on them.
Wasn't good.
I'll admit it. I got wrecked. I got ballsy. I got excited. I bought into the hype and the bait. I thought the dust settled, and I was like, "Let's go." It's okay. I got my ass waxed, but I hedged my position with SQQQ. So my long term got smashed, and I lost a lot of money. We'll leave it at that. But I did make a decent bit of it back, about $40 or so of it back, through hedging with the inverse leveraged NASDAQ fund, the SQQQ.
Personally, I don't think that's really the most efficient way to hedge your portfolio. If you were going to do that, then you should I think you might just want to stick with options. Maybe buy more longs or more calls than you would puts.
Yeah, that's actually a perfect segue into my final talking point on it.
About it.
And this is my favorite way to short the market, to play the downside, would be puts. And a put, in order to understand a put option, you got to understand options. We'll have to have an options episode. If you don't understand it, this is where we say goodbye. No, I'm just kidding. I'm just kidding. But yeah, this is going to be mumbo jumbo for a sec. But when you buy a put option, what you're doing is you're buying the right to sell a stock at a predetermined price in the future. So
that's the idea behind it. You don't necessarily have to buy the stock. Yeah,
you don't have to. You are buying the option. So let's say, for example, I'm going to use the call option. I'm going to use the call option because that's the easiest way to kind of teach about it, because we're programmed to buy and hold.
Okay.
As human beings. So a call option gives you the right to purchase a stock at a predetermined price in the future by paying a small premium for that right. So, Nathan, how do insurance companies make money? Do they sell insurance or do they buy insurance?
They sell insurance.
There you go. So basically what you're doing is you're going to the insurance company on your portfolio.
God, I got to tell you, I was afraid I was going to answer that wrong. I thought I was going to have like a huge brain fart. They buy insurance.
They buy it.
All right, continue.
When it comes to options, that's what it is. You either get to be the insurance company or you get to be the insured person. So with a call option, let's say I'm going to use Coca Cola here. We're going to I got a good idea, Nathan. I want you to tell us what a call option is, and I want you to use your Coca Cola example, because Nathan had a great day today. We're going to toot his horn real quick.
Yeah, buy Coca Cola. It's my boy right now.
Nathan did well on Coca Cola, and we're going to use him. Can I use you as a trading example here?
Yeah, that's fine.
Let's do it then. So around what was the stock price at when you decided that you're thinking about a call option?
$43 and about 26 cents.
Okay,
actually, it was more like around like 43.40 cents.
Okay, so let's call it 43.40.
Okay.
And you wanted the opportunity to buy Coca-Cola at $44, correct?
Correct.
So in order for that contract to go through, you paid a small premium. I'm going to use easy numbers because I'm sure yours are confusing and people are listening to us and they probably already hate us enough. So I'm going to use easy numbers here.
It was 20 cents.
Oh, okay. That's easy. Okay, let's do that. So you paid 20 cents per share. Each contract is 100. I know. This is all, oh man, we're losing everybody if they have no idea what we're talking about. Yeah.
It's been great.
So each contract reflects 100 shares and it gives you the opportunity to buy those shares in the future at a predetermined price. So Nathan said, if Coca-Cola goes above $44, I want to buy it for $44. So if Coca-Cola went to $50, you get to buy it at 44. But the only way for that to happen is if the stock price hits 44. If it never hits 44, you lost all your money on your premium.
Yeah.
So you wanted that right. Did you legitimately think Coca-Cola was? Did you do a little research, or were you kind of just playing?
Okay, so I did do research. This is what I did honestly. I'm starting to just get into options, and I wanted to make a safer bet. And so I said, what are some good companies? And then automatically what dinged me, the Dow Jones 30. And I kind of flipped through companies, and I was like, KO, Coke. Oh, well, I know Coke's a good company. I like Coke. They've got good numbers. And the Dow Jones has been on a down run for a while.
So you're pulling out the laggers of the Dow.
Yeah.
And you wanted to trade them. I like it.
Yeah, and I said the Dow Jones is due.
Yeah. So you expected a small little pop in Coca-Cola.
But not a huge pop. I didn't expect it go to the moon, but I said, well, I mean, it's had a
You think it was going to go above 44.
Yeah.
You thought it could go another 60 cents up.
Exactly.
So what you did is you paid that 20-cent premium 100 times. So you put $20 down to control 100 shares of Coca-Cola.
Right. Correct.
And as the price of the stock swings, the value of that contract swings. So as it ticked closer to $44, your premium eventually hit your sell order at
40 cents.
There you go. So you doubled your money. And how many contracts did you have?
I had 3 contracts, and I bought a dip, so...
There you go. So you bought the contracts on a fat dip, and then Coca-Cola ticked up, had a nice, somewhat beautiful of a little day, kind of followed the market, did that little stairway thing. Yeah. And you were able to profit off of it.
Absolutely.
So you caught the upside without actually owning the stock. Now we're talking about playing the downside. So let's do the complete opposite of that.
Okay.
Instead of wanting the right to buy Coca-Cola at $44, let's say you wanted the right to sell Coca-Cola at $42. So if you think Coca-Cola was going to drop below $42, you would pay that small, let's say it'd probably be about the same premium, about 20 cents.
I think when I was looking at it, puts at that time were around 40 cents.
Okay. So let's say you bought that 40-cent put option. And as the stock was ticking down, you eventually thought, oh, hey, if it continues to tick down, I want to catch the downside. So if you wanted to buy a put option, that would give you the right to sell the stock at a predetermined price. So if you bought that 42 put and the contract or the stock price went to 39, you got to sell at 42.
Yeah, the idea behind that is you really want your whatever price, they call it your strike price. Right?
Strike price. Yeah. We're going to have an options episode where we're going to break this all down and we can actually maybe revisit this whole thing.
The idea is to get, if you're doing a put and you want to sell it, you want to sell it at a higher price than what your strike price is.
Mm-hmm.
So that's why when you go down and it gets below your strike price, you want your strike price to be above the price at some point. Because at that point you can take the difference, and then those are your profits at that point.
Exactly. So like I said, so we just used the example of $42, and it goes to 40. That extra $2 difference you get because you get to sell it at 42.
Yep.
And the person on the other end, because they entered that contract and took the premium, they agreed to buy them from you at 42, regardless of where the stock price was at that time. So because they entered that contract, they hold up their end of the bargain, which is made legitimate through the broker-client deal. You are a profiting man. So it gives you a way to play the downside by putting a lot of money, without having to put a lot of money down. But it's also, it is way more volatile than leveraged ETFs. Because you're using a derivative and you're controlling hundreds of shares at a time. It's a little bit more of a complicated concept, but basically all it is selling, buying a put option and playing the downside on that. All it is, in very layman's terms, is selling at a predetermined price in the future. That's all it is. you are paying money for the right to sell a stock at a predetermined price in the future. And there can be a lot of upside with that. Oh my God, there can be so much upside to it. There can also be so much downside to it. You can, and I struggled with that a little bit this week.
I struggled with it with Coca Cola, man. I bought it at 20 cents. I bought 2 contracts at 20 cents. So 20.
You watched it screw around on you?
It went down to 10 cents, and I bought another contract.
So you bought the dip.
Mm-hmm.
So by dollar cost averaging in, you are able to have more funds to play more downside to increase your overall gains in the end.
I quadrupled one of my contracts and doubled the other 2.
There you go. You got like a nice 300% gain.
It was nice.
That's beautiful. So put options are personally my favorite way to play the downside. The one reason that I prefer that because there's more liquidity than selling short, and it's way easier to do, and you can use less money. But the reason that I prefer puts overall is because you can do individual stocks and funds rather than with inverse ETFs. You're doing sectors or overall markets. So if I think Ford is going to go down tomorrow, I can actually go in and buy a put option to specifically choose Ford. And I can put a small bit of money down to say, hey, if it goes down, I want to play on the downside. But if it goes up and I lose that money, it's not enough for me to lose sleep over.
I got a question for you. Maybe you know the answer, maybe you don't.
I got an answer.
Are beavers rodents? No, I'm just kidding.
We were talking about that before the podcast. Are beavers rodents? If somebody knows the answer to that, I'd like to know.
When let's say I buy some shorts. All right.
So what do you mean buying shorts?
If I want a short position and I'm going to go to my broker, he lets me borrow them. I'm not talking about options.
Actually short selling.
Yes, I'm going to do some short selling on, let's just, for example, Ford.
Okay.
What does that do to the price of the stock? How does that affect the movement of the stock?
Well, if a lot of people are doing it, obviously it's going to push down the price of the stock, because the concept behind the short sell is that you're selling it in the open market immediately. So if everybody shorts a stock because they think it's going down, the active short selling actually will push the stock down. But what you have to remember is that they have to purchase the stock back. And when there's tons of sellers at once, what happens, Nate? Price does what?
The price goes down.
And when there's tons of buyers?
The price goes up.
Exactly. So everyone who short sold and pushed that stock price so down that when it decides to bottom out and they want to lock in their profits, everybody's got to buy this shit back now.
Yeah.
Monkey see, monkey do. So those massive buy orders to cover back the short position bring up the stock price. Now, sometimes a lot of people will short a stock, something of high interest like GoPro. I'm using an example. This isn't an exact scenario, but it happens every now and then. They're very hard to identify. But the concept is called a short squeeze. And what happens when a short squeeze...
This is a cool idea.
Oh, it's a great concept. So it's funny because it just rings their fucking bell, man. With a short squeeze, the short sellers are wrong, and the stock price goes up. And the margin departments at the big broker houses start demanding that you either start selling off your position or you put more money in. So what they do is they instantly start flooding back in to buy their position, which then causes the price to go up even further. So because there was more buying originally and all the short sellers were wrong and the stock price started to tick up, well, now all those people on margin, they've got to cover their asses. So that creates that massive short squeeze and will just increase the price just so high. And you don't really realize it's happened until it's already happened. It's not that's hard to identify. It's not something you can really time either. If there's anything that you're going to try to use to time it, the first thing you would look at would be the short interest. And that gives you that's an exact metric that shows you
That's
how many people,
also known
how
as the
many
short
shareholders
ratio.
are short? How much of the stock has been short? The short ratio, yeah. What did I say?
Short interest, but it's the same thing. It's the exact
short
same
ratio,
thing.
yeah. So if it's a 60%, that means 60% of shareholders are short this position right now.
That's another fundamental thing that I kind of look at when I'm buying stocks is what's the short interest, what's the ratio. If it's a high short ratio, it's not I'm saying it's bad stock. I'm just saying it raises.
It's something that you want to. Yeah, it raises the red flag. Absolutely. One thing that is good about those short interests, though, if everyone's already shorted the stock, everyone's already beat you to it. So don't try to follow them and think it's going down even further. If it's already at like a 90% ratio, you're done. You lost. Find something else. But the thing that you got to watch is it can't be sold short that much more. So the only other thing that can happen is that all these people got to buy the stock back. So if there can be just a modest pop on one of those tiny shitty stocks, if there can be a modest pop, that's enough to short squeeze maybe at least 15-20% of the holders right then and there.
Squeeze them.
So and you're just at that point you're just playing the fundamentals and the fact that they have to buy their stuff back. Traders do crazy things like that. In these brokerage houses, they do these crazy things like that to kind of manipulate the markets. For example, there's another podcast I listen to called the Power Trading Radio. I don't know if I like them enough to put their link in the show notes quite yet.
Jesus.
But one of their guys actually was a floor trader, and he was telling a story about when people in Chicago on the options floor, when nothing was really going on and everyone's kind of standing around, some brokers would just start selling everything, and they would call it fishing. And what that meant is they were fishing for stop loss orders. So they were trying to push the stock price down. They were just selling their position. They would just dump everything they had so that they could do the opposite of a short squeeze on people to kind of get everybody to just panic out, and then they'll buy everything for cheap, and then push it back up.
They did that on what's it called? What's that movie? Trading Places.
Trading Places.
Yeah. At the end of the movie, they're on the commodities floor.
Mm-hmm. Fishing for stop losses. So they do that shit to, it's not really manipulation, but at the same time, it's exactly what it is. It's manipulation. Nathan, I thought of another way of playing the downside, and I don't know. So far, have I missed anything? Because I got one more quick little snippet that I can add.
Here, let me say this, and this kind of has to do with me and my market notes. If you really think about a bad economy, 2008, there's a couple stocks that did really well, and this is my theory. I don't know if this is really a proven thing, but 2008 stock market crashes. What are we doing in a recession? We're not going to Ruth Chris, are we?
No.
Where are we going?
We're buying Campbell's food.
And we're buying McDonald's dollar menu items.
McDonald's dollar menu. That's what I did during the recession. Yet again, I was 16. I was already broke.
Yeah, and a lot of these kind of like Walmart also did good during the recession.
Mm-hmm.
McDonald's
Proctor
did good.
Gamble, household goods, Campbell's soup, stuff like that.
I feel like there's these microeconomic decisions that will come through during like recessions.
Mm-hmm. Depending on what it's based off, what the recession is, what's happened. I mean, there's certain ways that you can profit massively off a recession. Yeah, and you know what? This perfectly ties into my last point, Nathan. God, we are just fucking great.
Mm-hmm. Long RTG.
My last point was hedging with either like precious metals or utilities, or maybe some other thing like consumer staples. So basically, rather than looking for the direct downside and saying, if the market goes down, I want up, yeah. There's other things that you can do to say, well, if the market's going to go down, I want something that's going to be steady, such as Procter Gamble, Pepsi, stuff like that.
Johnson & Johnson,
Unilever, Johnson & Johnson, things that that don't really have that consumer cyclicality, and that people will always need. Like, people are going to buy deodorant. People can buy toothbrushes, baking soda.
A bad sector to buy in a recession would be, like, for example, cars.
Oh my God, automotive.
Auto industry.
Because people aren't buying cars. And this is almost just common sense.
It's macroeconomics.
This is macroeconomics. the first time I ever met you, we were in economics class.
I don't remember you in that class. I slept a lot.
You did sleep a lot. You were like right in front of me, or like next to me. I remember you were like right there.
You always wore that hoodie, didn't you?
Yeah, I had like 2 or 3 hoodies that I always wore.
I remember you always had a hoodie on.
It was cold, man.
It was cold in that school.
Yeah. But, I mean, all that stuff is kind of just basic knowledge. One of my favorite ones to look at is utilities. Because in a recession, you know, people are going to pay their utilities.
No, it's not they're just going to pay their utilities. They're going to pay their utilities first.
Yeah, that's
at the end of the day.
Like, I feel like you pay that before your mortgage. Like if I was that tight on money, if I was that tight on money, and unfortunately, so many Americans out there are, but if I was that tight on money, I would pay my utility bill first before I'm paying my mortgage, before I'm paying off my car. I'm buying food, I'm keeping my lights and my heat on, and I want running water like that. I need that.
You can go to work, but let's say you don't have a house to come to. You're just going to live on the streets? No, you want somewhere like warm to come to after a long day at work.
Yeah. So you're going to pay your utility bill.
Yeah, regardless how you get there, you're going to want to pay those utilities first.
So, yes, they will struggle just because they're stocks, and stocks do bad in recessions. There's just no getting around that. Stocks do bad, but there are things that do significantly worse than other things. And at least with the utilities, you know, you're going to get those dividends the whole time. You're going to get, you know, just because you're in a recession doesn't mean that the utilities industries are going out of business. There's no way. They're fucking monopolies. But by parking your money in the right places, utility is not only the only one. Gold, you can buy gold by owning stock. There's there's gold mining companies, there's gold mining funds, there's funds that own direct physical gold. There's all kinds of stuff that there's ways that you can play the gold and precious metal markets in stocks.
What's your gold position right now? You have any gold positions?
Funny enough, I have really never ever played gold in my life. But I did for the first time on Monday.
I was about to say.
Yeah. I played NUGT, NUGT. It's a triple leveraged gold miners fund. And I did that because I just knew, you know, from reading the reports in the morning and seeing what was going on, I thought the markets were just going to do shit. And I know gold performs very well. If you look at a chart, it's not a perfect correlation, and it never is. But for the most part, gold does the exact opposite for the day than what the S&P does. It's not always, like I said,
always.
But most of the time, you'll notice that if the market is up, gold is down. Sometimes they go up together. There was a hell of a time for like months they would go up together. And that's just weird. A lot of people were weary of that.
Yeah, a lot of and when we get to our Forex episodes much later down the road, you'll see a bunch of commodities, especially countries that, like, for example, Australia is a big producer of copper. When the price of copper goes up, the Australian dollar is going up as well.
Because that's a big part of their economy.
Mm-hmm.
It's all relative. It all goes back to each other. You know, things relate to things. The steel tariffs go to the Ford Motor Company. The Ford Motor Company, people got to buy cars. They're now more expensive, so they're giving more to the motor. You know, it all has an effect. It's all a system, and we're all playing the game to this machine, this corporate machine. So playing the downside, those were basically the four. You have the actual short selling. You have playing through inverse ETFs and leverage in inverse ETFs. You also have put options if you know what you're doing and you made out our gibberish. And then you have just basically hedging through other sectors and alternative assets such as gold and precious metals and silver and stuff to utilities by even changing into different sectors like consumer goods or packaged goods or tobacco. You want to park your money in some tobacco and vice stocks, alcohol during a recession? People are going to smoke cigarettes. People are going to go to casinos. There's things out there that do fairly well in recessions. Absolutely. You definitely want to do your research. You don't want to get burned. 9 times out of 10, you're already too late.
You don't want to just say, oh, we're in a recession, buy tobacco.
Mm-hmm. It's not that simple. It's not that straightforward. Well, what kind of recession? Well, what caused the recession? Okay, people aren't paying their student loans. I think that's going to be the next one. Like, okay, well, is that really going to devastate the economy? Well, no, it's going to devastate the government. It's not going to devastate McDonald's if people don't pay their student loans. It's going to devastate the government. So then, there's just, you got to know what you're doing. But the point of this entire episode is you have to understand that there is and there always will be downside. We need it. There has to be downside. But just because there is downside and people think, sell everything, the market's going to zero tomorrow, sell it all. Because it's just easy to say that when you're ignorant as fuck. You don't know that you can make so much money playing the downside, and there's ways to play it every single day. Granted, you can't sit there and try to time everything. You can't sit there and say, well, I think at this moment I'm going to short it here, and then I'm going to buy it here, and then I'm going to short. It doesn't work like that. But if you take all the factors and all your knowledge all in together and you say, well, hey, I think my forward holding is going to do a little rocky over the next few months with all these tariffs. So I'm going to put on a small put position, and I'm going to keep buying my forward. But if my put goes up, I'm going to sell for profit and continue to buy more. By having that knowledge and knowing that the downside may come and preparing for it, you're going to make all the monies and you're going to do better. People than, I have a 401k. Well, you can't short sell in a 401k, can you, Danielle? I just threw a name out there.
Sorry, Danielle.
Yeah, you can't do those kind of things. In a recession, in your 401k, in your recession, you're just fucked. Your mutual fund manager isn't timing the market. He's not selling your positions for you. He's just riding the tide. He don't give a shit. And you are subject to that. But if you take the knowledge and you build your own financial freedom, you can do it yourself. Don't fear the downside. Fucking embrace it. I was ready for the plummet of the earth this morning. I gapped up on a 7% gain on my entire portfolio because of it. So accept the downside. It's here. It's a thing that happens. Granted, we don't like it, but it's just got that stigma. But there's ways that you can make money off of it. So stocks move in two directions: up, down, up, down, up, down,
and sideways.
Gotta look at it that way.
Dividend payers that go sideways.
That's the game. That's all I want. So Nathan, did we miss anything on the downside? We got the short selling, we got put options, inverses, and then we've got I'm just going to call it diversification.
Yep.
Asset allocation.
Yeah, there you go. Asset allocation's great. I know if we did miss something, go ahead and email us at rebeltradinggroup@gmail.com with 2 G's, rebeltradinggroup@gmail.com.
Yeah. Has anybody emailed us yet?
Nothing. Not on it right now. You guys don't love us. You need to send us some emails. Send us some questions. Send us some corrections. Let us learn with you. Mm-hmm. We're not experts. We're not financial advisors. We're just two guys talking about stocks.
Yeah, I'm trying to act as the funnel of information. I want to take all the things that we've learned over the various resources and websites and podcasts and news and experiences, and I want us to act as the funnel for you. I want you to open your mouth for the beer bong funnel, and we're going to just cram some knowledge down that funnel.
Cram it down, baby.
And you're going to take it right down the throat. Nathan, what are you watching this week?
I don't really know. Let me see.
You want me to go first while you're thinking about it?
Why don't you go first? Let me look at my portfolio, see if I have anything new.
Funny enough, we had the short or the downside episode today. But funny enough, I'm watching the Ford Motor Company once again this week. However, I'm not going to use that one more than once a month. But the reason I'm watching it, I'm actually watching it, surprisingly, for the downside. She seems to have ticked up relatively nicely, but I'm not buying the fact that the dust has settled. I just think today was a nice day and it was a good day for us. I just don't think that all the tariff talk and all the hashtag tariff talk, I like it. I don't think the dust has settled, and when the market is ready to take another small downturn, I think the Ford Motor Company is going to be one of the first things to go because of its volatile sector in the automobiles. So I'm watching Ford on the downside. I'm considering a put option, probably the 11 put, maybe the 1050 put going out a little bit further. But that is me. Downside Ford Motor Company, and I didn't pick downside just because it's happening. It just happened to be that way.
Yeah,
so
that's
fuck.
fun.
I'm aggressive.
So I am watching one of my holdings right now is YINN, ticker symbol YINN.
YINN. YINN. Yankee India November. Tell me about YINN, bruh.
Well, it happens to be a 3 times leverage exposure. It's a direction FTSE Daily China Bull ETF. And it has exposure to a cap-weighted index of the 50 largest Chinese stocks traded in Hong Kong. It's basically the Dow Jones of China. Mm-hmm. I think they call it like the Nikkei 30 or something like that. Or the Nikkei 50.
The Nikkei? That's Japan.
I don't know where it is.
Shanghai.
It must be the FTSE then.
It's something else. I know what you're talking about, though.
But it tracks the 50 largest companies in China, and then it multiplies it by 3. What
is the top holding on that, you know?
It's a bunch of like energy and banks in China, I think.
I was in, oh my god, CWEB.
Poor guy.
The double, oh man, dude, I got so wrecked on it. What is she at now? Oh my goodness, I bought this thing at $67. She's sitting at $51. She's a double leveraged Chinese internet company. Let's take the most volatile piece of shit and let's double its volatility.
It looks like it's about to be a buy right now, though. If you look at its patterns.
Honestly, yeah. If you look at the patterns, it looks almost a triple bottom.
That's like really supporty. Like you never see support that's like a straight line.
Jeez, we got some support right strong at 48. We're sitting at 51 now. We got some very strong support there at 48.
Buy.
Wow, interesting. Let's add that on the watch list. We are mutually watching CWEB. But what are you watching with YINN? Are you how are these going to react to the tariffs?
Oh, dude,
it's on the other side.
It's probably the worst.
Good?
No, it's probably no, because we have tariffs going over there. They have tariffs coming over here. Honestly, if I'm a freaking idiot for playing these two right now, but I'm in it for the long run. I think China's a great country to invest in. I think their market's going to be great to invest in over a 10-year period at the very least. So I'm long YINN. They have their Inverse ETF, Yang, YANG, Yin and Yang. That's not racist or anything. But they actually just reverse split Yang. Oh, it was trading at like $5, and now they split it back up into $50.
Dude, so do we short it $50 and let it ride to zero?
I'm thinking about it. Play the downside.
I agree with you on China, actually. It's hard. It's really hard right now. If you think owning anything in America is difficult, and things are a little scary right now compared to what's been going on over the past 2 years. But if you're willing to handle some volatility and you have a 25 plus, I'm even going to narrow that to a 10 plus year outlook. You want to be in China. You want to be pouring money in China because they are going through a middle classification. So basically, they're having a lot less poor people, and they're having a lot more middle class people who in America make anywhere between $45,000 to $80,000 a year. They're for the first time starting to have discretionary income and are going out to more restaurants. They're increasing their quality of living. They're getting bigger houses, and they're actually traveling more. So more money is being pumped into not only that economy, but the global economy. But what you need to understand is there's 3 billion of them and 300 million of us.
I was reading that.
Which market would you rather have more buyers in?
I don't know if this is true or not, but I read somewhere that like 1 in every 7 people is a millionaire in China. But like if you multiply
I've heard that in Hong Kong.
Yeah, if you multiply that by like however many people are in China or whatever, it's kind of a weird number.
Yeah. Well, there's I mean, you're either the top of the top or the bottom of the bottom for the longest time there, and that's because of their free economic system and their loosening of the restrictions. They are expanding and rapidly. And my other favorite thing that I really like about China is they are corrupt. I'll say it. The Chinese government is corrupt, and they manipulate their stock market.
Let me say something. They just got rid of their term limits for their president. So right now, this was like in 2018. This happened this year.
This is the emperor now.
Yeah, he is now like a lifelong, life-serving political leader. So you talk about corruption, that's like right there for you.
Well, not even necessarily with their government, but in their markets. They appoint a member of the government to each board of every publicly traded company.
Jeez.
It might have to have a market cap of something, but when you hit that market cap, they appoint a government employee so that they know everything that's going on at every exact moment. And the state, the country of China, as a state, purchases stock. So they manipulate the markets, because who's got more money than the Chinese government? Fucking nobody. So if they, it's just a theory, can't really prove it, but I just have a feeling that if these Chinese stocks take it on the chin long enough, their government's going to step in and they're going to manipulate this and they're going to push it up, because that is also an ego boost to their economy and them as a nation. Look how our stock market did this year. Look at our economy. Look how strong it is. Look how great everything is over in China. And I think that's something that they would do. That's just a theory. It's a very simple-minded theory, but
they got so many people. They got so many people that they can just brush it under the rug without anybody knowing.
Yeah. Who do you got to answer to when you are the government? Who do you answer to?
Yeah.
You don't even answer to other governments.
Well, I think it's a pretty long podcast as it is. This will hold people over for next week.
It was a good one. It was intense. Lots of stocks we got to put into the show notes, but we'll break those down because we mentioned the inverses and the regulars. So we'll break them down so that you know which ones are inverse, and we'll put in what the names are. And I also want to give the Invest Talk plug in there. Another great podcast. Literally learned so much of everything that I know today from those people over there at KPP Financial.
Yeah,
and
check them out online.
Absolutely.
KPPFinancial.com or something. Or I think it's Invest Talk, 2 T's.
Yeah, you go to investtalk.com. They do episodes every day. It's actually a radio show out in like San Jose, Bay Area, San Francisco, California. And it's a radio show, but at the end of the show, they edit it and release it as a podcast available for free for everybody, both on their website and through Apple. So if you go to investtalk.com and you're interested in checking them out, they are great. I know we have competitors in this realm, but they are somebody that I would absolutely stretch out to. If you love the content we're giving you and you want even more, you'll love them. Oh my God, you're gonna love them.
Yeah, that's another thing I meant to tell you about. Sooner rather than later, we're gonna start uploading stuff onto SoundCloud. I'm not even gonna ask you. I'm just gonna tell you we're gonna do it. In addition to our YouTube content, and in the future we are doing we're gonna have face reveals, and we're gonna have actual video.
Yeah. We'll do some live videos. We're going to do some live videos. Unfortunately, we don't live anywhere near each other. We're about 5 hours apart. But very soon, hopefully, I would like to take a trip out there, go have some fun. We'll go do some gambling. And we'll do a live episode. It'll
be a Biloxi cast.
Yeah, live from the hotel room. Maybe we'll go to the beach. We'll do a live video.
We'll do a live podcast from the craps table.
Yeah, and then when we get kicked out, we'll go to the room and do the live podcast.
Yeah, we'll continue it, yeah. So stay tuned, everybody. We thank you for joining us.
So stay patient with us. Yeah, we do appreciate watching the videos. I hope someone is learning something.
Yeah.
I hope that we're making someone's day. I hope that someone enjoys. Like I said, if I can just help one person when I'm doing this, then my job is done.
What if you don't help anybody?
If I don't help anyone, then we are just sitting here talking shit about China.
That's okay.
Yeah, someone's got to hear it. So, unfortunately, no episode on Friday. No dual episode on Friday.
I might do a short one.
Nathan, I think he should. I would really like to see that.
If you want to hear me do a podcast on Friday, email us at
If we get one email, we'll get another podcast going on Friday.
I'll do it personally, and I'll shout you out. If you don't want me to shout you out, I won't. But
maybe we'll see your face.
Yeah, maybe.
Maybe you can do like with the pigcast.
My sweet little pig.
Pigcast.
Pigcast.
All right, man. Well, I had a blast. This was fun.
Yeah,
man. Playing the downside. That's how you do it.
Thanks for joining us, guys.
Thanks for joining us. We'll see you not on Friday. You'll see Nathan on Friday. I will see y'all on next Wednesday.
Have a good one.